What's up, Gould Miners? In today's episode, I have the honor of interviewing Abhi Jain, the CEO of RealVal, an overseas company that specializes in underwriting and deal analysis. Abhi and his company literally see tens of thousands of deals come across their desk every single year. And so this guy is a wealth of knowledge when it comes to commercial real estate here in the US. In today's episode, we go deep into the trends that Abhi is seeing both in the multifamily and self-storage sectors. We also discuss some of the challenges that are present in today's marketplace and how investors like me and you can take advantage. So buckle up, everyone. This is a great one. Welcome to the show, Abhi Jain. Abhi, welcome to the Gould Mine.
Thank you so much. Thank you for having me.
Of course, yeah. No, it's awesome to be able to talk to someone that gets to see a lot of deal flow, and I'm really excited to dive into what you're seeing right now in the current market and kind of the trends that you've observed and what you're predicting for 2024. But for those that don't know you, that just tuned into this podcast, why should they stick around and listen?
Yeah. So let me just introduce ourselves, like myself and what we do, and basically why I'm a person who can give a good analysis on how the 2024 can go by and what we are seeing in the market for majorly all the asset classes. So we basically help active and passive investors, both like private equity groups, individuals, and all the people who want to invest in real estate, underwrite deals, analyze them whether they are feasible according to their goals or not. Then for syndicators and private equity groups, we help them prepare pitch decks and prepare models and all that stuff. So we work in majorly all the asset classes across the US, and our only clientele are in the US. So we are fully focused in the US, and we primarily do multifamily, like residential part. Plus, we have other teams, other managers who also do development and other hospitality asset classes. So we majorly cover all of them and have a good grasp of all of them. So basically, I started as an intern in a chartered accountancy firm, which is basically a CPA firm, similar to CPA firm. I'm a chartered accountant. And so during chartered accountancy, I was auditing for first couple of years. Then I went to the banking industry, and after banking, I started I completed my chartered accountancy in 2020 during just at the beginning of COVID. And right when that hit, the job market fell down, and we couldn't get any jobs, any new hire, any freshers were not getting jobs. I and some of my friends started freelancing through Upwork and other platforms, started gaining traction with US real estate in 2020, 2021. The real estate market was at the peak. So we started getting traction, started working with a lot of investors, a lot of groups across the real estate asset classes. While we were gaining traction, there was a limit to our time. And in 2021 or so, we started our company, RealVal, and we started hiring people. And we are a team of about 25 people right now.
That's awesome, man. So you started this company, RealVal, and just to reiterate here, you do your services include underwriting primarily for passive and active investors, private equity groups, syndicators, and you started this company. This is your baby. And now you have 25 individuals working with you. That's amazing. That's massive growth in a really small amount of time. That is not an easy feat. So congratulations, first of all.
Thank you so much.
Of course. So obviously, you you started freelancing on Upwork, and you probably saw some good money come from that. But there's a lot of things that you could do with your background. So what inspired you to get into the underwriting space? What was it that drew you to that?
So the analysis part, the financial models, that the intricacies in Excel that I see, all of us that we work in RealVal, we love Excel, and it's the main tool that we work on all day. So the financial analysis part and linking one thing to other. So let's say why, so while we are underwriting a deal, 10 things are linked to the returns. So why the returns are being affected by one thing and how are they affected? We like look at that and like analyze all that stuff, and why analyze why the deal is working, why is it not working, and prepare like complex models for customized transactions and all that.
So when you are, well, let's take a step back real quick.
Yeah.
Let's take a step back real quick. Can you give us an overview of the type of underwriting services that you offer? You mentioned, you said apartment buildings, multifamily.
Yep.
You also said hospitality, development.
Yep.
What goes, like for someone that's unaware, like what goes into that sort of process? Obviously you're using Excel.
Yep.
You're plugging in a lot of numbers.
Yep. But
the question that comes to my mind is, how do you ensure quality when it comes to because understanding a real estate market sometimes it requires like a lot of like in-depth knowledge of a local area, right? So when you're underwriting, say in, I don't know, Nashville, Tennessee, right? There are certain intricacies of that market that only someone in that market or someone very familiar with that market would truly understand, versus like, say, you know, Miami or, you know, Muskogee, Oklahoma. I mean, there's like, I'm just giving you a bunch of different examples, right? But like, how do you ensure quality and what is it that you guys do in order to ensure that you understand the intricacies of any given market?
Right. So there are a couple of things that we do that help us and will obviously, as we keep on moving and keep underwriting more, will help us underwrite and analyze deals or assume assumptions more in a better way. So whenever we are underwriting and finalizing a properties analysis, we always take the end results and the existing historicals to we have a set of data where we input all the data that we are for the property that we are underwriting. So all the historicals, so let's say rents per unit, the vacancy, the purchase price, the cap rate, so we plug in all that in a sheet. We have all that data for all the deals that we have underwritten so far. So let's say if we have 10,000 deals that we have underwritten for the past 3 years, we have that data for majorly all the like cities or for all the states. And what we do with that data is we have, let's say if we are underwriting for a new client that doesn't have experience in a particular market, we can go back to that data and see how the trend has been, how particular the size of property runs. So what kind of expenses do they incur? And we also research about the rent growth and all that in the open market and CoStar reports and all that. So using that, we can get a better idea of what we can project for the property that we are underwriting. Plus, like we have standards, like standard of procedures for each underwriting, and we have. So let's say like the type of, so first of all, I'd just like to answer the three to four types of underwritings that we do for different kinds of investors. And usually these are customizable. So basically, an investor who wants to underwrite very aggressively and wants to do, let's say, 800 deals a year, right? So we can maybe do a quick pass and do just 10 to 20 minute study about the deal and see if it's worth looking at. Then the other could be the other analysis could be a very small model, just a back of the envelope model, where we take the initial numbers, just a high level number, and put in those numbers in the model, spend about an hour, and then we see if the deal is worth working on more and working on like worth spending more time in the full-fledged model. So we get an idea of the market and basically the going cap rate, the rents, if there is an opportunity in the first analysis with the first 10 to 20 minutes. In the second analysis of like, let's say 40 to 45 minutes or so, we get an idea whether the deal is worth looking at and is it worth spending more time in the underwriting, due diligence and all that, and finding the comparables. So in the second one, we try to underwrite it very aggressively with the, let's say if we have brokers' assumptions. So we will try to underwrite it aggressively using brokers' assumptions and see whether the deal is working even at brokers' assumptions or not. So let's say if the pricing of a particular property is $20 million and the broker is saying we can probably increase the rents by $300. So we'll see whether, let's say if we increase the rents by $300, whether it's feasible to pay that price or not. And if not, yeah. So a lot of deals, like 75% of the deals won't even work at the assumptions that the broker is suggesting and the price that they are offering. So only 25% of them passes to the full-fledged underwriting, where we spend some time and dig deeper.
Gotcha. Okay. Makes sense. I want to talk a little bit more about the 10 to 20 minute, rough, rough and dirty kind of analysis. So what goes into like a 10-minute analysis? Can you talk about like the data points that you'll look at and what assumptions you're making in order to let's just use multifamily because it sounds like that's what you spend the majority of your time on. So what does that 10-minute quick and dirty look like and what data points will we looking at?
So one thing would be the location of the property. So we usually know what every client wants, let us know what kind of asset they are looking for, the location they want to invest in. So we try to see what kind of location the property is located in, the crime in the area, the schools, the basic demographics that we can see initially, and how much retail is nearby, what kind of other comparables do we have, and are they what kind of renovations do they have. These are some non-financial things that we see initially. Plus, for the financial part, what we do is take a look at the current trends and what the broker is suggesting, and what could be the target rent after, let's say, if it's a value-add property, and we know the broker is saying $200 premium after renovation. So we'll say the target rents would be $1,000 current rents plus $1,200. So $1,200 after renovation, that'll be a target rents. So what's the rental yield based on that $1,200? So rental yield is basically total rents on the whole property, whether it's a multifamily. So $1,200 multiplied by, let's say there are 100 units. So 1,200 multiplied by 100 multiplied by 12 to convert it to a year. So that divided by the total purchase price or total cost of acquisition. So usually, let's say around somewhere between 10 to 12% yield is decent. Anything below that will be subpar. So we take a look at that plus just take let's say quick and dirty analysis of, let's say there's a $1,200 rent. There will be approximately, let's say $100 of other income, and out of that 40% of that is going to be the expense. So there will be let's say $1,300 and let's say $600 or $700 is the NOI. So based on that, what's the yield to cost and what the client is like what the client want to target, whether it's feasible or not. If it's too far, we'll just leave it. So these are the first a couple of things that we would take a look at and see whether it's whether it's reasonable for us to spend more time in that particular deal or not.
Gotcha. Okay. And once you get to a certain point, I'm assuming you let the client know. So let's shift gears a little bit here, Abhi, because what I really, something that you said earlier, obviously you've been growing rapidly. You've got new people that are working with you. You're kind of crossing into new asset classes. One thing that I've been paying attention to over these last few months is how AI is disrupting the underwriting space.
Yeah.
And I think very soon there will be AI models that are able to underwrite properties, kind of like the quick and dirty style, maybe not as intricate as you would get from like someone that really understands the market and really understands, the asset class, but the AI is going to be able to do a lot of what you guys are doing. So what are you doing to hedge against AI, right? Or do you look at it as more of like an asset to your organization?
That's what we are using. So we are using AI internally as well. We are.
Nice.
So it's basically like a partner that helps us analyze things more quickly. So usually, let's say if you're getting some data from the owner that's very complex and rough to, we need to simplify that. So there are AI tools that simplify those things. And there are some AI tools that automate the categorization of the historicals so that it gives us a quick summary of the T12, like what kind of incomes there are, what kind of expense there are, what's the NOI. So using that, we just take the end result of the simplified rent roll and the T12 and put that in our model and use that for the further analysis, like the comparables, like doing the demographic research and seeing whether the true comparables are what other comparables are true comparables, and seeing what target trends we can achieve, whether the broker's target assumptions are reasonable or not.
Are you using AI right now primarily to underwrite multifamily deals, or are you also using it for hospitality and other asset classes?
Majorly multifamily, because like multifamily is, you can say it's simplified version, because in development and in hospitality, there are much more complex deals, and usually deals are customizable and customized ways for financing, and usually those are larger deals. And those are customized with different financing and different kind of reports. So for example, in hotel, usually there's an SGR report. And with that, we using that, we forecast our assumptions for hospitality for hotels.
I would have to imagine that there are potential customers who balk at the idea of outsourcing their underwriting, taking it, especially to an overseas firm. So how have you overcome the stigma of, we're outsourcing the labor, it's going to another country, and maybe they don't understand the market as well as we do. So how have you overcome that particular objection?
So first of all, like initially when we were freelancing, there wasn't that much a stigma that we need to outsource. So we were able to get more traction initially, but in recent times we have been asked this question, and how do you know real estate? How your analysts know real estate, particularly for US? So what we have done over the years, we have created training modules for each asset class, for each kind of underwriting, and we have created them. And whenever we have we onboard a particular analyst, we train them on those modules for the first month, and after a month they stay on the role on the back end, help other analysts underwrite deals, do the projects that they are doing with the client, with their live clients, and they do those projects on the back end in let's say 3 to 4 months, once we are comfortable with the quality of work that the analyst is doing, and we review their work. And only after, once we are comfortable, we allocate those analysts and those team members to the new clients.
Love it, man. I'm going to put you on the spot. Out of all of the different asset classes that you underwrite, which one are you most bullish on in 2024?
So there would be a couple, I would say. One is, of course, multifamily. Multifamily has been strong for quite a while, even during COVID and even after that, even during the interest rate hike. Not really, it's not in as bad position as other asset classes. So one would be multifamily. I'll just give you a couple of more reasons for that. The second would be self-storage. And for multifamily, I think multifamily, in addition to multifamily, it'll be MHP as well. So basically, affordable housing is is increasing. The necessity for MHP has been increasing in recent times due to basically having a need for more affordable housing. So for multifamily, there's about I think in 2024, I read a report from CBRE. There's about $49 billion of loan that's getting due in 2024. And that $49 billion is a huge amount. Either that's going to be refinanced or has to be paid off. So in either of the cases, due to higher interest rates, a lot of investors who have existing properties whose loans are coming due will have to sell. And they'll probably have to sell at less than the price that they purchase it at. So that's a great opportunity. And we are seeing a lot of deals with higher cap rates and mid 6 cap rate, low 6 cap rates going in. And people are selling just at the amount so they can pay the debt. And so those things are happening. And for self-storage, what we have seen is there has been a fall in prices for self-storage. The rents have fallen by 20-30% in the last year, in 2023. And self-storage will stay strong because even if the US goes into recession, there will be a demand for self-storage as people will move into smaller houses and will have to store their stuff somewhere. And that will be self-storage.
What are some of the challenges? So you just spoke to one of the challenges right now, which is there are owners who are taking a loss right now because of the current interest rate environment. What are some other challenges that you're seeing right now in the market, as it stands?
One of the challenges that I have seen with the particular asset class is office. Everyone knows that office has been booming since COVID. That's majorly due to work from home culture. And I've read a study where it says about 1/3 of the work days are still are work from home rather than work from office. So with that, there has been a culture of there has been a hybrid culture in offices where the demand for office space has reduced quite a bit. But the other part of this picture is for as an opportunity, we have seen a lot of deals coming in where the office space is being converted into multifamily and a hotel is being converted into multifamily and student living. So those kind of things are happening where there is an opportunity to buy them at a lower price, then convert it to a multifamily. And usually the offices are down in downtown and they're costly, but so those are really good opportunities for developers.
You talked about self-storage, and I'm really curious. So are you seeing a lot of storage deals right now? Are you currently or underwriting those types of deals?
Yes, we are.
Okay, gotcha. What are some trends in the storage space, self-storage space in particular, that we should be paying attention to in 2024?
So, as I said, the rents have fallen quite a bit. They took a dip in 2023, even in the later part of 2022. But those dip have been for a reason, because the self-storage prices have been increasing quite a bit, very aggressively in 2020 and 2021. So we have reached a level where there won't either there will be, or there will be, but there won't be that much dip in the rents, right? So we can't perfectly know when what's the lowest amount of rent that what's the lowest amount of rent that's the self storage is going to hit. So we can't time the market. So, but it's one of the lowest trends, and it's one of the lowest dip that we have seen, and it's a really nice opportunity for acquisition companies. We have seen a lot of new developments coming in for self storages where they have not been able to lease up. So, we are seeing very cheap, like $110 per square feet, $115 per square feet acquisitions, even lower than that. So
that's really interesting. And I've talked to a lot of self-storage guys, and it's interesting that I think specifically in the self-storage space, I do know that it's like market specific, because what you're saying, I have heard some people say, but then I've also heard other self-storage investors who are like, dude, we're crushing it right now. So that's it's very hot and cold depending on the market, but it's very fascinating. Well, Abhi, we are coming up on time right now, my friends. So couple last questions here for you. The first one being, I would love to hear, a recent success story from a client, like, hey, like this is what, something that either a passive or an active investor came to you and would love to hear how you guys helped them get to where they wanted to be.
So this is story of one of our initial clients. We have been working with them for past 2 years, and they came to us asking for suggestions, and we curated process by discussing with each other on what their needs are. So we created a process where, as I said, doing a first pass, as they wanted to underwrite as many deals as possible. And in 2022 or 2023, in a year, we are averaging 800 deals a year for them. So
you're underwriting 800 deals a year.
Yeah.
Nice.
So those 800 deals are not full-fledged underwritings, and these are 800 quick passes, and only 25 or 30% of those 800s are passed along to the full underwriting phase. And
makes sense.
We curated a process where we have one analyst doing the first passes. That takes much less time. And once the deal passes on, that goes to the other analyst who does the full underwriting. So this helps the process to get done much quicker, get a response to the broker in maybe 1 or 2 days. And we also created that a dashboard where they can see how many deals are coming on from which market, which broker has been the best for them, which broker has been the most active broker for them, so they can create better relationship with those brokers and focus on those brokers. How many LOIs we have sent on with a particular broker for a particular market, so they can focus more on those markets which are working for them at a particular point of time. So we have created a dashboard which can tell all these things, and they've been successfully able to close 6 deals out of those 800 in 2022, and about 3 to 4 deals in 2023.
Nice. That's awesome, man. And by the way, those numbers do add up, because I'm thinking it usually takes about 100 deals to find a good one, right? Yeah. So internally, I'm like, okay, 800 deals, about 10 deals closed. That sounds about right.
Yeah.
So that's awesome, Abhi. Well, in traditional Gould Mine fashion, you're going to leave the audience with your final Gould nugget.
Okay. I would just say, so I've learned one thing. Initially, the reason why I opened up a company is because I was falling short of time. I was working like 16, 17 hours a day, even on the weekends.
Yeah.
And with that, I thought like I'm asking other people to outsource things to me, and I'm not outsourcing or delegating these things to others. I started hiring with my partners, and we started delegating stuff what we could, and we started training them. So this is what I would suggest to others as well. Do things that you are good at, that you think you'll make most value in, and outsource the other things. So if you think you can add the most value by finding off-market deals, or like building a relationship with brokers, or raising more money from the investors, or with making good relations with the existing investors, do those things, and you can outsource the other things like underwriting, preparing decks and models to anyone.
That's great advice, my man. I really appreciate you. Abhi, thanks for stopping by.
Yeah.
This was a lot of fun, man.
Thank you so much.
All right, cool. Of course.